As I'm stockpiling cash for my business and other people are having cash in their bank accounts, inflation rising, and what do we do to finding investment opportunities is really hard right now. What do we do? And he actually brought you up in the interview talking about a strategy around options trading and how you could actually be the house and not lose 90% of your or 99% of your money like most people use options trading. And this was very different. And so I'm just super excited to kind of now go to part two after talking to Phil and now about to talk to you about what is this strategy that if you're willing to really put in the work for people, and it's important everyone knows this, really put in the work on how this could actually be a wealth building opportunity for those who are interested like myself and the viewers. So I'd love to know, starting off for options, what are they? Calls and put options for the viewers to understand, and then we'll move into, as the interview progresses, more complex things. But starting off right there.
Thank you, Jeremy. That's a great introduction. It's nice to see you again. It's nice to be with you. The last time we were together, we were dining in Switzerland. So yes. I'm glad we were able to make this all work. I'm happy to jump into I'll talk, I think, really quickly about the simplest forms of these contracts. And then, as you mentioned, we'll go into some of the complexities. There's such a unique situation going on right now. So I'm very happy to share this with you. It's really the first time that we've gone public and talked about this. And if your viewers implement this, I'm sure they're going to make a lot of money. So why don't we talk about the basics? You asked about calls and puts. And so basically a call is a option contract that gives you the right to purchase stock at a specific price at a specific date in the future. So you buy this contract and it's tradable on the exchange. You can buy it through the Chicago Board of Exchange. And you're basically, you choose any underlying equity, like just whatever you'd like to choose. You can call it Apple. And instead of buying Apple the stock, you want to buy a call on Apple. You choose the price that you're willing to pay for Apple a certain period of time in the future. It could be 3 months, 6 months, a year. And you'll pay a little premium for the right to buy Apple at that price in the future. And then the outcome is it's either in the money or out of the money. So if the price of the stock is above the price that you're willing to pay, you still have the right to buy it for that price. That's what you bought. You bought the right to pay a certain price. And if the stock price is below the price, the contract expires. You wouldn't pay more than you could buy it for in the stock market. And so it just expires and you can go about buying the stock a different way. A put is exactly the opposite. So if we took a generic example and said ABC shares are selling for 100, the traditional use of put, which is not how we're using them, but the traditional use of the put is to protect your portfolio. So if you hold ABC stock and it's selling for 100 and you think something about the shares and you're worried they might decline, you could purchase some protection. So maybe you'd purchase the right to sell the stock to somebody at a certain price at a certain date in the future. So you might say, well, I'm happy to take a little volatility, but if it falls below 90, I'd like to sell. And so you would pay a premium for that right to sell it. And so maybe you'd pay, let's say $5. So you're going to go out 6 months and you're going to say, I'll pay $5 now. And if it falls below 90, I still get to sell it for 90. So if it drops from 100 to 50, you still have the right to sell it for 90. And so that's how a put protects you. And most people think of calls and puts as terms of buying them. So you can buy a call and it gives you the right to buy the stock, or you can buy a put and it gives you the right to sell the stock. Does that all make sense? It's pretty basic, fundamental option information. The way that we're going to get into here is all inverted, and but it's really simple. So instead of using a call to buy the stock because you buy the call, we use the put to buy the stock because we sell the put. So the put buyer allows you to basically sell the put or put the put to someone else at a certain date in the future if the price falls. If I sell the put, what it does is it gives somebody else, it's underwriting the option contract, it's underwriting the underlying equity. So it gives somebody else the right to put their shares to us. So in a hypothetical ABC stock equity situation trading at 100, the way we think about things, and very advantageous way of thinking about things, is that We approach this from a value investing perspective. We're looking to buy shares when they go decline in price. We're not looking to sell shares when they decline in price. And so if we know about something about the underlying business, if we know something about the management team, the quality of the management team, and we know that it's a very fair price for this business, and the shares decline, it actually entices us to buy more. And so in a situation where we want to be buying the shares, instead of buying them in the New York Stock Exchange for $100 a share, let's say that's what they're trading at today, we would instead sell a put contract committing to buying for $90 a share, and somebody would pay us $5 for the right to sell us the shares if they decline to 90. And then further, if they decline to 90 or beyond, our net cash outflow then becomes only $85 because $5 was paid. So we're literally lowering our cost basis to a price below the stock market price. So we are not paying retail prices for the stock.
This is like a heads I win, tails I win, right? So it's like either you get it, what you wanted, or if you don't, you do get a bit of extra cash flow coming off of that.
That's exactly right. So if you want to think about it like this, there are essentially four major buckets. This is a common question that people ask. So let's say we started in options 101. Now we're in options 201. Okay. So in options 201, people always ask, well, what are the potential outcomes? Okay. So you write a put on a stock that you want to own. There's sort of four fundamental buckets that could occur. And the mindset, so keep in mind, everything needs to come from a value investing perspective. I run a long-term value-based fund, right? Everything is coming at this from a value lens. So this is how to use options with a value bent to it. So there's four basic underlying buckets. Always think about this as owning the notional equity value. So if you've committed to buying 100 shares for $90, basically a share, you're basically committing $9,000 toward this transaction in terms of a notional. So what happens is once you own the shares, a few things could happen, and not once you own the shares, but when you've written this contract. One, you could be totally wrong in your analysis. Okay, it would be a terrible. The worst situation is the shares actually go from 100 to 0. All right. So instead of losing 100 where you had bought the equity, you now lose 85 because you bought for 90 and you were paid 5. So you actually decrease your absolute loss, you lower your risk. It's a risk reduction mechanism, but it's still a terrible outcome. Obviously, the shares just decline to 0. All right. That's one scenario. The other scenario, the most attractive scenario, is that the shares go from 100 and they decline to just below 90. They're put into our portfolio. They only cost us $85 a share. And now instead of buying for 100, we got paid to wait. We own the shares, and as the stock appreciates, we have a lower cost basis, and we literally have a higher IRR. Our annualized return is greater, and so that's scenario 2. Scenario 3 is the shares don't decline below 90, and we keep the $5 on our $85 in collateral. And I basically chose these sort of silly numbers, but it basically becomes a 5.8, almost 6% return. I said a 6-month contract, I believe. So we're talking about 6% over the course of 6 months, which is just fine. You can actually get quite significantly higher returns. This is a really basic scenario. That's the third outcome. So the contract would then conclude, and you would keep the premium. So you'd make your very reasonable IRR. The fourth scenario is you are correcting your analysis and the shares go straight from 100 to 300. You do, in that case, miss the upside. That's an unfortunate situation, but nobody seems to complain. Typically, you can earn a lot more, like 10, 20, or 20% plus IRRs with these premiums. So you're basically capturing a 20-something plus IRR in the premium, but you've missed a 200% gain. So I used a really small number. I just said a $5 premium on a 90 stock. That's probably not sufficient, but you may be able to do it. You may be able to get significantly more. You might get $10 or even $15 on a $90 strike price.
In order to not miss that 200% upside, do you allocate? So you do have a portion going into this company and you'd love to buy. You want to get that strike price. Do you go in at a position where, let's say it goes to $90 or it falls to $90. You get put the stock, and then it falls to say like $78 or $80. So another $10 comes off. Do you then do another options bet, or do you actually just decide to put in a second tranche of just capital into it without doing an options call that time?
Great question. So, and this is, we're still kind of in the 201 phase. Maybe we're getting into the 301. It's very different if you're managing a fund like ours, or if you have a very sizable, personal account, versus maybe a typical retail investor with 100 or maybe up to $1 million. So you would approach these in different ways. But what you're basically asking is, would you cost average or not? So you would have to evaluate your total notional exposure. You'd have to look at the percent allocation that you want within your portfolio. And if you have sufficient capacity to buy more, you do your analysis and you consider potentially selling another put. And that's exactly right. So you can cost average if things do decline further. And certainly it's something that we do. And yeah, you'll of course get paid another premium and it potentially higher IRR. So that's a very good question. It's nuanced for every individual portfolio. So it would have to be considered on a portfolio by portfolio level. But what I want to get into here, I want to kind of set this baseline at 201 where people understand we're inverting the use of these calls and puts in a very unique way. Most people have trouble, if they've learned it the wrong way first, they have trouble shifting their mindset to this. But we're basically looking to use these contracts not as speculative products in any way. We're not looking to trade these products in any way. We are literally using them as a tool to purchase the underlying equity. So instead of buying a call to get that stock, which is our cash going out, we sell a put to get that stock. So somebody else pays us and then gives us their shares. And so we get to buy the shares for less than they would cost in the New York Stock Exchange, less than they would cost to any retail investor. We're doing what I call structured value. So we're basically looking for ways to just lowering our purchase price, increasing our margin of safety, and getting access to these shares. So this is the fundamental baseline that all the viewers need to know before I get into this really unique situation that is happening right now, and people can make a fortune, and it's individual investors can apply this. I really encourage people that understand it to put it to work because it's quite lucrative at the moment.